Hello there. Gold price has increased by more than $600 since February this year. Wouldn't it be nice if gold miners were to catch up and overperform versus gold price? Talking about gold miners, let's have a look at some fundamental details of the top three among them. Those are Newmont, Barrick and Agnico Eagle. The details here are based on their Q2 reports. What we're going to do for these top three largest miners in the world is look at their discounted per share value after all-in sustaining costs, long-term debts and taxes. We are going to look at cash as well, although it doesn't go into the valuation model. Instead, we'll look at cash as just an additional way of assessing risk. So the valuation factors that do go in our model is of course gold price, the amount of reserves and resources that the miners have in the ground, all-in sustaining costs, the long-term debts, taxes. We'll look at per share value as well as time value of money. So we apply discounting based on average mine life, a bit of insider sauce, and cash as just another way of looking at risk. Starting with reserves and resources, Newmont of course is the largest at over 130 million in proven and probable reserves of gold in the ground. In addition to that, they have measured and indicated resources of over 100 million ounces. Beyond that, there are inferred resources, but we don't include those into our valuation model. Hence, we try to lean on the conservative side. Newmont also has nearly 600 million ounces of proven and probable reserves of silver, over 450 million ounces of measured and indicated resources of silver, and nearly 30 million pounds of copper each in reserves as well as resources. For Barrick, the endowment in the ground is a little less at over 75 million ounces of reserves of gold and 103 million ounces of resources of gold, 170 million ounces of proven and probable reserves of silver, and 820 million ounces of measured and indicated resources of silver. For copper, Barrick has over 12 million pounds of reserves and nearly 34 million pounds of M&I resources. Agnico Eagle's gold reserves are at 52 million ounces, M&I resources of gold are at 43.9 million ounces. They have 55.7 million ounces of reserves of silver and 61.2 million ounces of resources, M&I resources of silver. Agnico Eagle also has some copper at 1,462 million pounds of reserves and over 220 million pounds of resources. We'll try to model the value of those endowments in the ground for three scenarios, with the balanced scenario plugging in the gold price of $2,300. Our conservative scenario plugs in the gold price of $2,000 per ounce, and the optimistic scenario only goes up to $2,600 per ounce. As you see, with the current gold price above $2,500, even our optimistic scenario is somewhat conservative. In general, as I mentioned, we do like to lean towards the conservative side. After all, you don't want to be too emotional in your investing activities. By the way, for rational investment ideas, make sure to join us at myfinanceteacher.org. As you see, the members get early access to the details on much more gold and silver miners, both among majors as well as some most interesting juniors. And myfinanceteacher.org has the best nickel as well as uranium reports on the internet. By the way, the next uranium report is probably going to be published somewhere around mid-September. There's been a lot of interesting developments in the nuclear industry. Coming back to precious metals, let's have a look at all-in sustaining costs, long-term debts, taxes and cash, where Newmont has the highest cost per ounce at $1,400. That's based on the guidelines for this year. Newmont also has the highest long-term debts at over $9.1 billion. For taxes, I just assume flat tax rate of 25% to speed up and simplify the process a little bit. Newmont also has $2.6 billion in cash. Barrick's all-in sustaining costs per ounce are at $1,370. Again, that's at the midpoint of the guidance for this year. Barrick also has over $4.7 billion in long-term debts, as well as the largest amount of cash at over $4 billion. Agnico Eagle's all-in sustaining costs are only at $1,225 per ounce, with the long-term debt of $1.2 billion and over $920 million in cash. Next, for shares outstanding and discounting, Newmont has 1.15 billion shares outstanding, and the mine life of the reserves at current annual production is over 20 years. If you add half of M&I resources, the average mine life extends to 28 years. Moving on to Barrick, they have 1.75 billion shares outstanding, with a reserve mine life of 19 years. Adding half of M&I resources extends the average mine life to 33 years. Agnico Eagle has 500 million shares outstanding. Average mine life of reserves is 15 years. Adding half of M&I resources extends that to 22 years. As it takes time to extract the precious metals out of the ground, turn the reserves into cash flow, we do take into account the time value of money, and the discount rate we apply here is 7%, which by the way has increased from our recent rate of 6.5% in some of the recent videos. Later on this year though, I might reduce this discount rate back down to 6% if the Fed does actually reduce the Fed funds rate as expected. Let's see about that. In the meantime, let me know which discount rate you would like to see here. For now, let's move on to the most interesting part, the actual valuation, starting with the conservative scenario where we plug in the gold price of only $2,000. And in this scenario, we only look at the value of proven and probable reserves in the ground, without looking at M&I resources, never mind inferred resources. Of course, this does give us pretty low valuation here at nearly $37.50 for Newmont, nearly $14 for Barrick, and nearly $38 for Agnico Eagle. I do look at it as some sort of a risk measurement. If gold price were to drop out of bed over the next few weeks, this is what could potentially happen to the miners. Next, looking at the balanced scenario, let's plug in the gold price of just $2,300. And in the balanced scenario, we still only look at the reserves, proven and probable reserves in the ground. That gives us around $58 for Newmont, nearly $21 for Barrick, and nearly $53 for Agnico Eagle. Next, most excitingly, let's look at the optimistic scenario, plugging in the gold price of $2,600. And in this scenario, we'll look at proven and probable reserves in the ground, as well as only half of M&I resources, never mind any of the inferred resources. And this scenario gives us over $202 for Newmont, nearly $44 for Barrick, and nearly $89 for Agnico Eagle. Lastly, but most applicably, if you compare these valuations with the current share prices, you'll see that currently the share prices are somewhat above the balanced valuation, but they're still considerably below the optimistic valuation. That sort of suggests that given these assumptions we had with respect to, for example, discount rate, taxes, and so on, the miners are sort of pricing in the gold price somewhat above this balanced level. Miners perhaps are pricing in $2,400 on gold price. So there is still some room to catch up, even for some of the largest miners. As for the rest of majors and perhaps some of the mid-tiers, stay tuned for that. And of course, for more details, join us at myfinanceteacher.org. Have a wonderful Wednesday. Bye bye.